Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns Inc. Tim, always a pleasure to visit with you. And today, going to be talking about rising interest rates and all that rising interest rates impact and affect, which actually is a lot more than I really realized.
I don't think most of America realizes what the Fed does when they're raising rates. I mean, we all look at it as, oh, the mortgages, the mortgage rates went up. But it's actually going to affect a lot of different things. And we're going to dive pretty deep into that today.
Yeah, well, we've heard a lot about the Federal Reserve and their actions and initiatives this year. And what we've seen in the market is attributable to the Fed's direction in rising and raising and continuing to raise interest rates into the future. They've stated that that is their goal, and they expect to have more market challenges and difficulties ahead as a result, but that what they are doing seems to be more important to them. But we need to understand what all continued rising interest rates impacts in our personal investing and retirement savings and progress. So if you've got questions or concerns, if you would like to have a complimentary portfolio and retirement review analysis and strategy session, if you would like to get your Protect and Grow written retirement income plan, pick up the phone and give Tim Stearns, CFP, and TJ Stearns Inc. a call at 800-640-2256. That's 800-640-2256. Now, Tim, the Fed, the Federal Reserve, kind of has this dual mandate. They are tasked with doing two things.
Well, two things are, number one, to tame inflation. All right. So their idea is their goal is to get it to 2%. Unfortunately, that has not been the case. We're at over 8% right now. They've done five rate increases this year. They're probably going to do another 1 to 2 before the end of this year. And, their whole idea here is to get the interest rate inflation, down to 2%. And obviously the horses are kind of out of the barn, and they're kind of working double time to get the inflation under control.
Yeah, kind of let the cat out of the bag, so to speak, with letting inflation get away from them in the first place, but somewhat predictable with their policies leading up to 2022 with the Great Recession and the quantitative easing rounds that ensued after that. And then just as they were beginning to talk about sort of calming that down, COVID came around, kind of a financial emergency that they felt they needed to address.
I remember an article about 10 years ago that said you can thank the bull market to the Federal Reserve, like to your point, quantitative easing, buying the market up to try to get a soft landing. Obviously, that's where they went against that now. So what that does is, number one, if you have bonds, it's going to hurt the bonds that you currently have. For every 1% that the Fed raises interest rates, it's going to hurt your bond values by about 9%. It's not an if, it's a when. Okay, that's number one. Number two, if you have stocks, and if you're into the NASDAQs and that type of thing, the technology stocks, you're going to have interest rates rising. So that makes it harder for tech companies to borrow money to hire, to do R&D, research and development, et cetera. So you're seeing the NASDAQ getting the worst of it right now as they're raising interest rates. So it's hurting bond values and it's hurting equities. And that's why you have this market that we're looking at right now.
Once again, talking with Tim Stearns, CFP, about rising interest rates and what all within the economy and our personal financial progress those increasing interest rates impacts and effects. If you've got any questions or concerns about what you are seeing in your investment portfolio, your retirement accounts, pick up the phone and give Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256. The second of those mandates, Tim, to promote full employment. And a recent headline that I saw said that there were actually 2 jobs available for every 1 person seeking one. So I think that they feel as though that mandate is actually being met. But backing up from this conversation about what the Fed's mandate is, let's give this conversation a little context. What is the Fed and how do they operate? If you could give us kind of just a brief synopsis of that.
Well, the Fed has been around since, the early 1800s, through Alexander Hamilton. And basically what they do is that they're trying to make sure that we don't have crazy recessions, depressions, etc. They are the money suppliers. They can pull money out and they can put money back in. Right now, they are pulling money out of existence. And what that does is that causes pain and hardships for some people. If they want to go out and buy houses, it's harder because the interest rates are higher than they were. People a year ago, year and 3 months ago, let's say, were buying houses and getting mortgages for sub 3%. And now they're well over 6%. So you're seeing the housing market cool, housing prices cool. These are all the things that they're trying to hamstring, and they're doing a decent job when it comes to that. But with this interest rates moving up, you're not seeing CDs going through the roof, where they don't respond as quickly, or money markets or anything that's a fixed income object like that. So I just see a lot of people not very happy with interest rates, whether it be their bonds taking hits. And that's a pretty simple concept. If you have a bond at 3% and they raise their federal funds rate 0.75%, the new bonds are coming out at 3.75%. I have an old bond at 3%. Does anyone want mine? Not really, right? So what happens is I have to entice someone to buy my old bond at 3% because the new ones are out at 3.75%. And you're seeing people having to take losses on bonds, which was not always the case. So you're seeing a stock market getting hit and bond prices being hit. And it's just kind of a perfect storm for not wanting to be in the market. Now I'm going to flip that on you and I'm going to say what vehicle will stay up with this crazy inflation we have? Usually it's equities, but equities are down anywhere between 20 and 36%. And so these are things that all need to settle down. I think it's going to be a long road ahead of us until they get inflation under control.
Well, Federal Reserve Chairman Jerome Powell has stated that he expects and accepts continued market turbulence, volatility, and losses as they adjust interest rates. They've stated that their goal is around 4.4% and several increases subsequently to get there. But as they continue to rise rates, Jerome Powell has stated that, yes, there will probably be more market volatility and economic hardship as a result. The Fed itself, I know, prints money, controls the currency in circulation. I know that they set interest rates. And when we hear about that, that's the interest rate at which banks can borrow from each other and borrow from the Fed itself. And so if our current rate, Tim, is gone from 0.25% up to 3%, well, banks in turn look to make a profit. They lend to us as individuals and to corporations, and they don't do so at the same interest rate that they've borrowed money for. So we in turn actually pay a much higher interest rate than what we hear being discussed and what the Fed has currently raised rates to. And that's why we're seeing these mortgage rates around 5.5%, 6.5% or higher, when last year they were at 2.5%.
Right. And if you remember even farther back, they were down at almost 0%, correct? So, I mean, we see it has been a whirlwind storm in the last, year here with interest rates. So the average inflation rate over the past 100 years was about 3.15. And in our college classes, we always talk about that as being the average. I don't know what the average is going to be after this craziness. The 80s, I saw my brothers who are in their late 60s now borrowing money at a higher rate, getting better money markets, that type of thing. But now it's, you're seeing people having to pay, from double what their interest rate was on a mortgage when they're going to buy a house. It's going to affect a lot of people. And then you see rents at their all-time high. It's like, what is good about this right now? And that's tough to say. And that's why I go back to anything that you own right now, you should have stop losses on them, whether it be stocks, you can even have them in bonds, and you can, and by doing that, you can stop the hemorrhaging that you're seeing in your portfolios.
Well, again, if you are concerned with the market volatility that we have experienced, concerned with the possibility that we could continue to see more downturns and losses in the market, then it is time to put a plan together or review and evaluate your current investment holdings and portfolio, ladies and gentlemen. Tim Stearns, CFP, can help with that and offers you that ability, no cost, no obligation, with the help and experienced eye of a qualified professional. No cost, no obligation. Just pick up the phone to get the conversation started and contact Tim Stearns, who does offer that protect and grow planning review strategy session, the written retirement income plan. 800-640-2256, the number to call. That's 800-640-2256. So Tim, as Jerome Powell and the Fed continue to raise interest rates, one thing that we have already seen and will likely continue to see, which has a big influence and impact on the rest of the economy, is mortgages, the housing market, and home values are impacted by interest rates.
Yes, and it's interesting how, one domino sets off the rest of the dominoes. So I think people right now that have retired in the past year might be thinking, wow, did I go too early? Should I have stayed in that job? And that's most of those people that are worried about that don't have a plan. And it's not too late to get a plan, even if you're a year or 2 or 5 years into your retirement. We could go back and take a look at what's going on. So you'll feel better about it and make sure that you're not having to go back to work when you're in the 70s because of inflation being, at a hyper level. These are all things that we help people with. The other thing we've helped people with time and time again is when to turn on Social Security. Do you wait? Do you take it when you're 62? Do you wait till you're age 66 if that's your full retirement age, or 67 if your other retirement age? These are things that people need to look at and make sure that they did the right thing when they went to go retire, or if they're thinking about it and they're taking pause because they don't feel like they have a plan. Give us a call.
Now, this is a little bit of the which came first, the chicken or the egg scenario. Social Security is predicted and it has been announced will receive a historic cost of living increase into 2023. This is actually not tied to interest rates. The rising rates, Tim, are in reaction to what Social Security increases are tied to, which is inflation. So a little bit of a silver lining there on the higher inflation is that Social Security recipients do receive that increase, but typically it's not usually been enough, historically anyway, to keep up with the actual inflation and cost of living, Tim.
I just read an ARP article talking about how, they raised Social Security last year 5.9%, and then they raised Medicare almost about the same, right? So it kind of washed out what the gain was, right? Because of what happened this year, they are going to reduce it for next year, thankfully, from like 171 down to like 151, around there. But my point is that they're not doing it this year. You don't get a redo. So maybe they catch up with you next year. But this whole year, you've been paying for a drug that wasn't as expensive as they thought it would be. And that's not really fair to the American public. So it's a kind of a guesstimate. Like I say, they try to get it right, but they don't always, just like the Fed is doing the same thing right now.
Well, it's also a reason why you need to take a good, long, proactive planning approach to your benefits, such as Social Security, and make the most of that, because it is not going to typically constitute everything you need in retirement and does not typically historically keep up with the true cost of living and inflation. But Tim Stearns can help you run that evaluation and help you understand all of the different claiming strategies and timing options to optimize your Social Security income and hopefully reduce a little of the stress that is placed on the remaining income that you need to generate from your portfolio. Again, that's part of the Protect and Grow Written Retirement Income Plan. And if you would like to take advantage of the offer to have that put together with the help of a certified financial planning professional, Tim Stearns, CFP, just a phone call away. Give a call, 800-640-2256. That's 800-640-2256. But Tim, most existing mortgages locked in interest rates, but those coming into the future, they will certainly be at a higher interest rate. Adjustable rate mortgage holders need to be aware that their interest and their payments may increase into the future. And just doing a little bit of math, the same $500,000 home at a 2.5% interest rate that was available last year, for the same payment, we could only afford about a $350,000 home today. So moving up in home just because we could afford it, that's probably going to slow, if not come to a pretty quick halt based on these rising interest rates.
But we're seeing it around here where people are, they're overpaying last year and now they're taking pause and kind of not, they're not going to pay over and they are realizing that they can't get as big of a house as they wanted. So these are things that are going around, and that's for people who are buying houses. Now, people who are, and they're older and they're slowing down a little bit and maybe are going to sell their house, great time to get out, but where are you going to live? Rents are at their all-time high as well because people can't afford mortgages.
Well, and renting was becoming a challenge because of inventory out there, right? There were not enough homes and there were more buyers on the market. We hear the term buyer's market, seller's market. I'm not sure if this is actually either one of those markets, but here's the deal is that developers and builders finance as well. So the costs for them to build new homes has also increased. So really the housing market, one of the areas largely affected by these rising interest rates, both on the builder developer level and on the individual level. Tim, you talked about bonds, but I want to circle back to that because bonds typically are what has been traditionally, historically considered the more conservative side of an investment portfolio. We can't use the word safe, and even safer, probably not the correct word, but bonds have been thought of as not being as volatile, not going to lose as much value as stocks in the market. So when we see a year like this year, it is really a shock to the system for more conservative investors, or even those that understand a more aggressive risk tolerance, but have a more conservative side of their investments.
Well, I think what people did is they got lazy. We had a 13-year bull market, and they didn't realize, or they forgot, or they didn't want to know that the market could correct, right? And it's basically done that. So, those people got kind of caught in the crossfire. And that's why I tell people all the time, you should be actively and strategically watching your money and investing it, and making sure that you're being dynamic and moving with what's going on out there. A lot of people are the buy and hold. It's just not a thing for this market at all. I've heard the argument, you got to be right twice. Well, I will take my money and go home. While the market free falls, what some of these guys are saying that, well, the market's going to be up by the end of the year. We don't see that at TJ Stearns. What we see is having stop losses in place and being actively management is the way to go. And if you're interested in not losing money, I would say give us a call because we'll take a look at what you're in and see if we can help you, especially if you don't have a plan.
Well, unfortunately, some of the damage has already been done. New York Times cites bonds' worst year ever in one of their headlines, and then Forbes kind of echoed it, except in question form. Is this the worst year ever for bonds and fixed income from a recent Forbes article? And the aggregate U.S. bond index ETF down about 14% year to date, Tim. A lot of conservative investors didn't want to nor realize that they could lose 14% of their portfolio value, especially in the side that has been more conservative. So a real shock to the system again. And ladies and gentlemen, Tim Stearns, CFP, has laid out his approach in reaction to that is that you should have a plan in place proactively to prevent and avoid losses. And if you don't, or are seeing losses that you're uncomfortable with, give Tim Stearns, CFP, and TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256. We mentioned the cost of living adjustment as one silver lining. I guess another one, Tim, is that if we are savers, bank style savings accounts, checking, money market CDs, we should see an improvement in interest rates, right?
Yes, but like I was saying earlier in the show, there seems to be a lag. It hasn't, my gosh, did mortgage rates go up fast? As you would say, they took the elevator versus the rates on money markets, CDs, and that type of vehicles are
They're taking the stairs.
Yeah, exactly. And that's why I'm saying, that's great for money markets, that type of thing. But meanwhile, bonds are getting, hammered, the ones that we currently have. So new investments, that's a great thing. But the old investments, now what? So I think that gives pause to people who thought they were in a conservative vehicle. Even our bond portfolios, we have stop losses using the institutional money manager that we use. So, for us, that gives us a competitive advantage over other portfolios. And that's why I think that that's the place to be, is having stop losses, being dynamic, head on a swivel, whatever analogy you want to use. You can't just sit on your laurels and hope for a good return.
And not as many of us are net savers these days either. So it's not like we're going to benefit largely by these increases in interest rates. In fact, more and more of our day-to-day American lifestyle and society is regarding and requiring debt. For day-to-day purchases, we put things on the credit card, Tim. For larger purchases, we finance them, and that certainly is going to hurt a little bit more as interest rates continue to rise. And with our investments as well, Tim, this downturn in the market that we have seen, again, a little predictable in the fact that when the Fed changes directions and raises interest rates, we expect to see challenges to corporate profits. We understand the impacts on fixed income, but more Americans have a larger percentage of their total financial wealth in the markets these days compared to a generation ago. So we see a significant impact there. And Tim, for those that still remain, that have a pension offered to them through a company, this may not apply to a lot of people, but the people that it applies to need to take great consideration of the potential impacts that rising interest rates could have on their pension.
So if you're one of those people out there that have a pension that you're being offered a lump sum, this rising interest rate environment is not good for your lump sum. And let me give you an example. Let's say interest rates were around 4%, all right? And the lump sum pension that they're going to give you, the lump sum that you can move into an IRA, would be around $1 million in that example if it was $40,000 a year. All right. That same $40,000 a year, the lump sum with interest rates going up, they only have to offer you about $800,000. So look at the difference that 1% makes on a pension on the lump sum buyout. So if you have lump sum availability out there and you want someone to analyze it for you, we're happy to do that. We've done that for many different people who worked for, Allstate, Motorola, et cetera. We've had all these different people come to us and say, what's this? They're reducing the lump sum. What happened here? Let's get ahead of it.
Yeah. And Tim, when you brought that to my attention, sort of discussing the premise for today's program, I actually went and tried to do a little bit of research on it. And one of the articles I found, it illustrated the concept nicely, but it also sort of promoted that if you are facing that retirement decision and this applies to you, you have a pension option for a lump sum, that you may want to accelerate your retirement timeline. And I sort of laughed at that because that also presents some significant difficulties in this challenging market environment. So two sides to that coin there. And again, we've got to take all of this into account and plan very carefully. Educated, informed people do make better decisions. And ladies and gentlemen, that's the goal there at TJ Stearns Inc. And Tim Stearns CFP wants to help you make those better financial retirement decisions. That's why he offers to run the review, the evaluation, have the planning strategy session, and put together along with you that protect and grow written retirement income plan. If you'd like to take advantage, pick up the phone, give a call, 800-640-2256. That's 800-640-2256. Tim, interest rates are on the rise, and in certain conversations, we may even hear improving. Interest rates are improving, but obviously everything that we've seen this year, rising rates have many concerned. They are not without their difficulties. We need to understand the full implications.
I agree with you, and that's why I would get educated. Everybody out there, come give us a call. Come to our college classes. We'll be happy to help you.
As usual, Tim Stearns, CFP, providing a lot of information and food for thought on today's program. Knowledge is power. Knowledge is wonderful, but it is the application of that knowledge, ladies and gentlemen, that gives you a true advantage. So pick up the phone, give Tim Stearns, CFP, a call, 800-640-2256. Take him up on the offer for that complimentary review and retirement planning strategy session, an analysis of the risks that you are taking with your current investment strategy, the fees that you're paying for those investments and the advice that you're receiving, the taxes that you may be liable for, and mapping out your protect and grow written retirement income plan. 800-640-2256. That's 800-640-2256. Once again, Tim, always a pleasure all the time that we have for this segment of the program, but thank you for being our resource and bringing these important topics to our attention.
It was my pleasure.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.